CEAT is the next one in focus. It's in a sweet spot right now. Rubber prices have dropped close to 20% in 2018. Healthy auto sales mean more demand for tire companies. What's also working for the sector is the import duty levied on Chinese bus and truck radial tires. So is it going to be a smooth drive from here on? How's the quarter gone by? Or could there be some nails that could puncture growth? Let's pose that question to the company's CFO, Mr. Subbiah Kumar. He joins me right now on the show. Mr. Kumar, good having you. Thank you so much for taking the time out. You've recently done an analyst meet which has been widely covered as well, so you've answered a lot of questions that I already have. But I was more interested in thinking of how the trend line looks like for you on various parameters. So a recent piece that we did on the revenue growth numbers for the tire companies at large and CEAT in particular seem to indicate that the last 2 or 3 quarters have certainly seen a turnaround in volumes. What's led to this, if you can briefly mention that, and do you believe that that leg up that you've received in volume growth is sustainable going ahead?
First of all, thanks for having me on your show.
Pleasure.
With respect to your question, we are seeing some growth in certain categories. Commercial category is one where we have been seeing some growth since Q3 of last year. Passenger car category, the demand from original equipment manufacturers has been good for us in the last 12 months or so, and we see similar demand from us in the next 12 months too. Okay, so which is a good news as far as we are concerned.
What about the third one, that is TBR? How is that segment looking like?
See, commercials cover TBR as well as TBB, and ever since government introduced anti-dumping duty on import of tires from China, and also thanks to opening up of mining industry and overall growth in India, the TBR growth has been very robust and good. As far as CEAT is concerned, we have not been able to participate in that growth story fully because of capacity constraints at our end. We are expanding our existing facility. Sometime in Q3 is when we expect the brownfield project to start producing tires, and I'm sure we'll be able to participate in the growth from Q3. But in general, the industry is growing very well.
You expect these growth rates to last for a while? I mean, the reason I ask is that will you be able to make optimum utilization both on the price and the capacities of your new capacity coming on stream in the second half?
In case of truck and bus radial, that's where our first capacity is coming up. We expect to utilize that capacity well, and we expect the growth to be robust in the next 1 to 2 years.
Interesting. Okay. What about the two-wheeler segment? The landscape is fairly competitive, as I believe it's there across, but more so in two-wheelers. How has pricing been for you out there? And more importantly, how do you plan to further ramp up the two-wheeler tire space for you as a company?
See, post GST and a quarter prior to GST, or couple of quarters prior to implementation of GST, two-wheeler sector growth was flat. After demonetization, the two-wheeler tire industry was the one where the demand shrunk to a large extent. And post implementation of GST, also small dealers and distributors who were in the bracket of annual turnover about 50 to 1 crore, okay, they waited for some clarification from government before they went in for registration. So therefore that led to flat growth during that particular period. We see some signs of recovery in the two-wheeler sector, particularly in the last quarter, end of last quarter and beginning of this quarter. We expect the growth to pick up in the coming quarters in two-wheeler tire industry. Okay.
And
however, with respect to pricing,
please carry on.
Yeah, I am just responding to your question on pricing. Okay, while we have taken some price correction in other categories, in two-wheelers, our price increase has been marginal.
Okay. How does this recent fall in rubber prices impact you? I know crude has gone up, so that would have been a bit of a negative, but just this last 10 odd days, the fact that rubber prices have come off so much?
See, if you really look at it, let me make it simple to understand the impact. Natural rubber prices in Indian rupee has been hovering around 125 rupees plus or minus 5 rupees per kg, say ex Kerala. And the international prices are also more or less in line with the same. For tire industry, 1/3 of the raw material cost is linked to natural rubber prices. So the fact that natural rubber prices have remained range bound, so therefore it's been good. However, a large part of our raw material portfolio is also dependent on crude. Okay, so we are impacted on account of increase in crude oil prices, particularly some of the petrochemical products which become input into making of synthetic rubber, then fabric, etc. Has also been impacted. So I would say overall our impact on raw material prices is to the extent of about 2 to 3% of overall our cost in the current quarter, and we expect a similar impact on our raw material prices in the coming quarter too.
Okay, that's interesting. So, you know, everybody, or rather a lot of people believe that the fall in rubber prices would benefit tire companies, maybe some of the other sectors like shoes, etc. You're negating that theory, right? You're saying that this recent fall in international rubber prices hasn't had any material impact for you as a company. See,
there has not been big correction in the last 10 days that you mentioned. Okay, rubber prices did go up in the month of May. Okay, and it has come back to the levels of April, maybe marginally below. So, see, one of the reference for natural rubber prices in the international market is called as a SICOM. So, where the block rubber prices are in the range of around $1,400 to $1,450 per ton. Maybe a couple of months back, sometime in April, it was in the range of $1,450 to $1,500. So there has not been much of a correction. And second, the rupee has also depreciated in the recent months. So that has some impact. Third is that rubber attracts now little higher rate of duty, particularly post union budget, where the cess on all raw materials went up from 3% to 10%. So therefore, we are not seeing much of an upside from the some correction in natural rubber prices, as it is negated by currency depreciation and also increase in crude oil prices.
Okay, one final word, and that is on the PCR segment. Now, you know, I read the notes. All of them say that in order to expand your capacities, you will take on a bit of debt, but nowhere will your debt equity go above 1, a level of 1:1. So, you know, that is known now. What I wanted to know was that what happens in the PCR segment, would the growth over the next 2 years happen largely because of debottlenecking alone? And therefore, how much can you grow via this debottlenecking process? And can or should one expect a larger portion of growth in the PCR only to come in FY21 onwards?
See, for us, our capacity utilization of our current PCR capacity plant at Halol is fairly high. Okay, and we are in the last leg of, say, debottlenecking. Okay, that should give us some additional volumes. Okay, and for us to grow beyond the current financial year, we need additional capacities. Okay, so we are putting up a new greenfield project in the south, and we expect the plant to start production sometime in the Q2, towards later part of Q2 in the next financial year. And for source of growth for us would be the additional capacity coming up in the southern part of India. And the debottlenecking will take care of our requirements for the current year. Beyond that, it has to come from our new capacity.
Okay, we'll leave it at that. Thank you so much for taking the time out and speaking to us today, and all the best for the quarter. I look forward to talk to you post your quarterly numbers.